How banks make money without touching cash. You wake up one morning, check your banking app, and see the number sitting there. Calm, ordinary, reassuring. That number feels solid, stable, yours. But here's the uncomfortable truth. At this very moment, your bank may be earning money from that number without moving a single bill, without opening a vault, without touching a dollar in cash. No trucks, no stacks, no physical money changing hands. Just quiet math humming in the background. And that matters more today than at any point in modern history. Because we are living in an era where money barely exists in physical form. Yet banks are more profitable, more powerful, and more interconnected than ever. Interest rates move, screens flicker, numbers update, and value appears, multiplies, or disappears without anyone ever touching cash. So how does that actually work? How do banks make money from money they do not physically handle? To understand it, we have to strip away the myths, the comforting stories, and the polished marketing language. We have to follow the trail not of cash, but of promises. Because modern banking is not built on money. It is built on obligations. And obligations compound. Let us start with a simple scene. You deposit $1,000 into a bank. You imagine it joining a pile of other deposits somewhere safe. Maybe it gets lent out. Maybe it waits. But in your mind, it still exists as a single thing. In reality, the moment you deposit that money, it changes form. Legally, it is no longer your cash. It becomes the bank's liability. That sounds backwards, but it is the foundation of the entire system. From the bank's perspective, your deposit is a promise they owe you. An IOU, a number they must honor when you ask for it back. That obligation sits on their balance sheet like a quiet ticking clock. And here's where the system bends in a way most people never notice. Because while the bank owes you that money, it is allowed to use it. Not all of it, just most of it. This is called fractional reserve banking. It sounds technical. It is not. It is simply permission. Permission to lend out money that technically belongs to someone else, while keeping only a fraction in reserve. If the reserve requirement is 10%, that means for every $1,000 deposited, the bank can lend out $900. No cash leaves the building. No vault opens. No one hands over physical bills. The bank simply creates a new loan account. A borrower receives $900 in their account. You still see $1,000 in yours. Two people now see money that came from the same original deposit. This is not a loophole. It is the system. And this is where banks start making money without touching cash. They charge interest on the loan they created. Interest on money that did not exist before the deposit. Interest on a number typed into a ledger. If that borrower pays 5% interest, the bank earns $45 per year on money it never physically had. Now scale that up. Millions of deposits, billions in loans, trillions in numbers moving silently through databases. That interest income becomes predictable, steady, and enormous. But that is only the first layer. Because banks do not just earn interest from borrowers. They also pay interest to depositors. Usually far less. If you earn 1% on your savings and the bank charges 5% on loans, the difference is called the net interest margin. That gap is the engine, the quiet profit machine, and it widens or shrinks based on central bank policy. This is why interest rate changes dominate financial news. When rates rise, banks can often increase loan rates faster than deposit rates. Their margins expand. Profits swell. When rates fall, margins compress. Profits tighten. Either way, the game continues. But here's where it gets more abstract. Banks do not wait for deposits to lend. They create loans first, then find reserves later. This is one of the most misunderstood parts of modern banking. When a bank approves a loan, it does not check a vault. It checks your credit score, your income, your history. If approved, the bank creates a deposit in your name out of thin air. That deposit becomes new money in the economy. Only afterward does the bank settle reserves with other banks or the central bank to balance the system. In other words, banks create money by lending. Not coins, not bills, digits. This power is tightly regulated, but it is real, and it is enormously profitable. Because every loan is not just an asset. It is a long stream of future payments. Principal plus interest. Predictable, modelable, securitizable. Which brings us to the next layer. Banks do not always keep loans. They bundle them. Mortgages, auto loans, credit card debt. Thousands of individual obligations rolled into packages, sliced into pieces, and sold to investors as securities. The bank earns fees for originating the loans, fees for servicing them, fees for structuring the securities, sometimes fees for insuring them. By the time the loan reaches its final owner, the bank may have already been paid multiple times. Again, no cash touched, just contracts, just signatures, just risk transformed into products. This is where subtle irony creeps in. Banks are often described as intermediaries, middlemen, but in reality, they are also manufacturers. They manufacture financial products out of human behavior, out of mortgages, out of car purchases, out of credit card swipes. Your life decisions become their raw materials. Now add payment systems to the picture. Every time you swipe a card, tap your phone, or pay online, a small fee travels with that transaction. Merchants pay it. Payment processors take a cut. Banks take a cut. A fraction of a percent. Barely noticeable, until you multiply it by billions of transactions. Banks earn money simply by being part of the plumbing. No lending risk. No vaults. Just rails. Then there are fees. Overdraft fees. Account maintenance fees. ATM fees. Foreign exchange spreads. Wire transfer charges. Each one small. Each one justified individually. Together, they form a river of revenue. And again, none of this requires touching cash. But the most powerful mechanism is still invisible to most people. Time. Banks operate on time asymmetry. They receive money sooner than they pay it out. They charge interest daily. They pay interest monthly, or quarterly, or annually. That gap allows them to earn interest on balances that are temporarily theirs to deploy. Even tiny timing advantages compound when scaled. This is why banks obsess over liquidity management, over settlement cycles, over clearing windows. Milliseconds matter. Now let us zoom out. Why does this matter right now? Because cash is disappearing. In many countries, physical cash usage has collapsed. Payments are digital. Wages are deposited electronically. Bills are auto-paid. Money has become software, and banks are the operating system. This gives them leverage. Not just economic leverage, but informational leverage. They see spending patterns, income flows, credit behavior, risk in real time. They price loans dynamically, adjust fees algorithmically, optimize margins constantly. Meanwhile, the popular narrative says banks simply take deposits and lend them out responsibly. That story is comforting. It is also incomplete. The underlying reality is far more mechanical, more abstract, more powerful. Banks are balance sheet managers, risk engineers, time arbitrage specialists. They turn promises into profit. And the system works as long as confidence holds. As long as depositors believe their money is there. As long as borrowers keep paying. As long as markets remain liquid. When confidence breaks, everything moves at once. That is when the invisible becomes visible. Bank runs do not start with cash shortages. They start with fear. When too many people demand their promises be honored simultaneously, the math stops working. This is why central banks exist as lenders of last resort. To provide reserves. To restore confidence. To keep numbers from unraveling. It is also why banking crises tend to spread fast and resolve slowly. Because they are not about money. They are about belief. So here is the quiet question that hangs over the entire system. If banks can create money without touching cash, if profits are driven by leverage, timing, and trust, then who ultimately controls the value of money? Is it governments, central banks, markets, or the institutions that sit between all of them? And in a world where money is mostly numbers on screens, what happens when the screens go dark? That question does not have a clean answer, but it is worth sitting with. If this video helped you see the system more clearly, Take a second to like it and share it with someone who still thinks banks are just buildings full of cash. Because once you see how the machine really works, you never look at your bank balance the same way again.